to the public, and the call is being live streamed on the Transport for the North website to ensure openness and transparency. Members of the committee will attend the call virtually. The consultation call will replace the in-person Audit and Governance Committee meeting scheduled for today, but which has now been cancelled due to the ongoing COVID-19 restrictions. Okay, thanks for noting that. Can I ask for any apologies? James, have we had any?
Julie Openshaw is absent today, so Deborah Dimmock is representing TFN Legal. Okay,
thank you. Welcome, Deborah. Okay, let's just move to declarations of interest. Item 2. Members are required to declare any personal, prejudicial or disclosable pecuniary interest that they may have relating to items on the agenda and state the nature of such interest. So just pause there for a second. Anybody got any declarations? No? Okay, I think we'll take that as no. Moving on to item 3 then, minutes of the previous call. Okay, let's look at those. So page 1, any comments, changes? Page 2, 3, 4, 5, 6, and finally 7. Okay. Any changes, comments on any of that? Okay, then can the committee resolve that it's a true and accurate record? This is prior to formal approval, of course, at the next in-person meeting, as we can't approve these minutes on a virtual call. That takes us actually to the actions, and there was only one action in the meeting. And if I just refer you to section 8, page 8 of the meeting notes, and this was a question from one of our independent members, Kevin Brady, action 8.3. And Kevin asked why some of the actions were on hold until the new CEO had started in his role. And Paul advised that there'll be clarification on this at this particular meeting. So I think Ian, you were going to take that particular action point. Can I just hand over to you for a moment?
Yep. Thank you. I think it's probably worth just noting there's actually only one item. I think the report says 2. I think, as far as I'm aware, there's only one item that falls into that category, which is the assurance framework. I think the issue there is largely that there is, because we've got ongoing uncertainty around exactly what TFN's future role might be. There is still some uncertainty as to exactly what that assurance framework ought to be doing, and there have been ongoing discussions within TFN as to exactly how detailed it needs to be and exactly how into the fine grain of individual projects it needs to get. So I think what that item is really saying is we've got a new chief executive coming in. We need to make some decisions based on what comes out of the CSR and what comes out of the kind of ongoing discussions on TFN's future role. Obviously, if we're making specific investment decisions, recommendations, the closer we are to the point of decision, the more robust that assurance framework needs to get. So there is still some uncertainty as to exactly the exact shape that it needs to be. So that's really what was being picked up there.
Okay. Are you happy with that, Kevin?
Yeah, happy with the explanation. I suppose just in terms of the assurance framework, this has been sort of around a fair while now, hasn't it? And it's been reported. Well, we had the presentation, I think, probably 2 meetings ago, something like that. So I guess it does need to come to some sort of conclusion at some point, doesn't it? I guess. Yeah, no, my only comment.
Absolutely, and I think there's quite a lot of things. I mean, the risk register, which we'll come on to later, Kevin. I think what is running through that is the level of uncertainty that we're dealing with, and I think this is just one of those. It's kind of collateral damage from some of that uncertainty. So I absolutely take the point. You're absolutely right. We do need to land this at some point.
Okay, all right. Let's whilst you're on, Ian, I think probably it's time now to move on to item 4, monthly operating report.
Yeah, I guess it really is for questions. I wasn't. It's quite a comprehensive report. It's probably worth noting, Chris, that due to timing, the version, because the papers went out a week ago, the version that has been included in the papers is actually now being superseded. I think there was either the report for June went up onto the website either. I think it was either yesterday or this morning. If people want to have a look at that. But I'm quite happy to take any questions anybody might have on that monthly operating report. I think possibly one thing is worth drawing out that is in the June report is the financial performance through to the end of the first quarter. So we are reporting roughly £14.7 million worth of activity against an original budget of 15.2, and particularly on core funding. Once you adjust for just some timing differences on work getting done that is actually, we know, is in progress, one-off work on things like office refurbishments to meet COVID requirements. We are extremely close to hitting budgets, which is something that we've struggled with previously. So I think there is probably some good some good progress being made in terms of actually delivering the business plan there.
Okay, thank you. That's a positive update. In that case, can we throw open to members for any questions on the operating report? No, I think we take it as read, Ian. Yeah, as you said, it's very comprehensive and self-explanatory. Useful report to have on the committee. So thank you. In that case, can we move on to item 5, which is the internal audit update? It's got Lisa.
We've got Alex, I think.
Alex, can you pick that one up, please, Alex?
Thank you very much. So I'm going to take the report as read in regards to the detail. Just to highlight, obviously, there's no reports to present today. We've just got the progress paper. There's one review that is in progress, which is the governance effectiveness review. And just to note, in regards to that particular piece of work, we've had a questionnaire that's been circulated. What we did do in agreement with Ian is just to extend the deadline to make sure we captured more comments as part of the questionnaire. So that is just going through the debrief stage. And again, a draft report will be circulated soon. So that will come to committee members at the next meeting. But very much from our perspective, we're on track in terms of delivery of the audit plan. We've got dates set for the remainder of the audit plan. Risk management review has actually started this week. So from our perspective, it's going well in terms of delivery and in line with the deadlines for the committee papers moving forward. But I'm happy to take any questions. Obviously, a shorter paper today than probably when you have a detailed report. Thank you.
Any questions from anybody on that? No. I think everybody's comfortable with that. Fine. All right then. Thank you. Thanks very much indeed. All right. Can we move on to external audit then? Item 6. Are you doing that, Campbell?
I am. Thanks, Chair. Yeah, if I could just briefly take you to page 4 of the report itself. So this is our usual progress report. There are a number of national reports and publications in here, which may be of interest to members. I'm not intending to go through each of those, but they're there for members' attention. I think the main thing just to make members aware of is we have undertaken the start of our final accounts audit on your annual accounts. We've made good progress, so we're quite some way through. We've completed a lot of the substantive testing. We still have some work still to do. I'm expecting us to finish most of that by the end of July. Members will be aware that that won't include pensions, as we were always waiting for the pension fund assurance letter, so that will be later on. There'll also be work in respect of our value for money arrangements work, which will be ongoing, and also the whole of government accounts. So they're the three main areas that I think will cross over after the end of July. In terms of matters arising, there's only really one matter to note so far, and that's really just a classification issue in terms of capital between impairments and disposals of 2 million. But really there's no real impact on the accounts in terms of the bottom line for that. It's a classification between impairment and disposal. It doesn't hit the general fund. It doesn't hit the bottom line, so it's not a great concern as far as we're concerned. I'm happy to take any other questions, Chair.
Okay, thank you. Thanks, Carol. Any questions then from anybody on the external report? I guess the main concern at the moment from me, whilst anybody's thinking of any other points, is just the timing, really, making sure that we're going to hit the deadline. I mean, you mentioned there that you're hoping to finish by the end of July, so the most of it. So I guess you're on course for that.
We are. As I say, there will be the value for money work, which is a change in the code requirements this year, so that will be ongoing for a while yet. And also, as I say, the whole of government accounts, which is always done at the end. And then we're always waiting for the pension fund assurance letter, which I'm hoping we'll receive well before the deadline itself. So that's where we're at. I mean, just to make you aware, we have reported this in the past, but the value for money, we normally give the certificate once we finish the value for money arrangements work. So we can't give the certificate on the audit until we've done our auditor's annual report, which we have until sort of 3 months after we've signed the opinion. So obviously we're hoping to get that report out sooner than that, but it doesn't impact on the opinion itself on the financial statements. This is purely just the value for money side of the audit.
Okay.
Just to make you aware that will be ongoing for a while yet.
Right. Okay. Thanks for that clarification. Okay, I've got Kevin with a question.
Chair, I was on the same line as yourself, just in terms of seeking assurance around the timeline and assurance that from a management perspective, you're getting access to all the relevant documentation given the COVID restrictions. I just wanted to seek assurance on that. And with the VFM report, when you say that will sort of fall slightly behind the timeline, is that still the intention that will hit us in September though, or is it likely to fall behind the September meeting?
Yeah, I mean, I wish I could tell you that at the moment, but we're not in a position. Technically speaking, we have sort of 3 months after we sign the opinion to produce our annual auditor's report, which includes that VFM commentary. And we have other local government work ongoing. So my intention is to try and get that done by the end of September. But if I can't, I'll certainly do it as soon as we can after that date. In terms of the audit, it's been a very smooth audit. I've only been here, this is my second year. It's a very sort of straightforward set of accounts, got a good relationship with officers, the working papers are good. And it's usually a very smooth process, and it has been so far. So I'm certainly not expecting any problems in terms of the opinion in terms of the end of September. Obviously, the pension fund letter is out of my hands, but we're the pension fund auditor, so I'm not expecting that to be a delay. I would certainly hope not. Where it's in the hands of other firms, I don't have any control over that, but we do have control from our side on that side of things.
That's great. Thanks for that. That's helpful. Thank you.
Okay, I don't think we've any further questions, Carol. So thanks very much for the update. And if we could move now then to probably the main item today, and that's the draft year-end statutory accounts, item 7. And that's over to you, Paul.
Yeah, I'll probably share my screen if that's okay, just so we can all focus on the same slides, if that's okay.
That's very helpful. Yes, thank you.
If someone could just let me know when they've got the screen, which hopefully you've got now.
That's all good, Paul.
Good. Okay. I think first and foremost is the reason why we sort of presented it as a slide pack is that we felt it would be very useful to lift out some of the key elements of the accounts and focus on them, because I mean they are quite a long document, and it's it's required from a statutory perspective. So we're not focusing on the whole thing, but and very happy to take questions on the whole document. But we thought it was, for the purposes of the committee, it would be useful just to focus on a number of key areas within the accounts. In terms of what we're going to cover, obviously there's the public inspection period, the basis of preparation of the accounts, some of the key items that we would say the more material items within the accounts, the structure, and then go into the more detailed elements of the actual financial statements themselves. In terms of the public inspection period, we do make our accounts open to the public for a 30-day window, and they have the right to inspect all records and ask any questions to external auditors. I believe in the past that right has been exercised once, and I think all documentation to support the accounts was requested, which was a very extensive exercise, but one that was required to be done. In terms of this year, we've not had the obviously the accounts are in the public domain as we speak. They were issued for public inspection on the 7th of July, and they'll be open to public inspection until I think it's the 17th of August, which is 30 working days. As of yesterday, there were two viewings of the notice, and we think one of them was myself, and one of them was the comms, the head of comms in TFN. So it's potentially not a hot topic, I would say, at this stage. But again, we hold open, and if inquiries do come through, they'll come through, and we'll I suppose report on them and react accordingly. In terms of the accounts, they are prepared essentially as a local authority. The basis of preparation is set out in legislation, and they are prepared in compliance with the SIPFA code. The key thing to recognise from the SIPFA code is that there are accounting standards, and there are also statutory accounting requirements, and there can be instances where accounting standards and statute differ, and in that case, statute has precedence. I think probably the easiest example of that is around RefCus, which is and it was an item that Kevin raised in the last meeting. So this is expenditure that we pass to the TOCs, and they capitalise it in their balance sheet. So again, an accounting standard would normally say revenue funding, revenue expense, capital funding, capital expense. But in this instance, statute allows us to apply capital funding to a revenue expense. So that's just a statutory step out that we're allowed to do. In terms of the key areas of the accounts that I would lift out, I think there are probably 4 key areas, which is the IST phase 2 assets, which we'll come on to in a second. Obviously, what we mentioned before, which is RefCus, which is the expenditure passed to the TOCs, who in turn capitalise them. The pension accounting, which was the subject of quite an extensive presentation by Ewan Miller at the last meeting, but again, I'll re-emphasise that. And then there's the prior adjustment that I'll go on to explain. In terms of the first item, which is the intangible assets, these members may or may not recall, but there are 3 tools that were devised as part of phase 2. There was a FAIRS data tool, a disruption messaging tool, and what was called an open data hub. So these were assets that were funded by the department, and we developed them for either essentially for use by the LTAs. Some of them we were intending to keep. So we were intending to keep the disruption messaging tool and the ODH for initially for a longer term period. This is the reason why they were capitalised in the first place. The FAIRS data tool was one that ultimately we were developing to then pass back to the department. As members will recall, on the 4th of January, the funding for the IST programme ceased, and therefore at that point a decision was made. You know, we were unable to carry the fixed assets any longer because we had no, I suppose, long-term use for them. So they were in the FAIRS data tool was disposed of, and the two other tools were what was called impaired, which effectively means they're written down to a zero value and transferred to the from capital assets, transferred from the balance sheet into the CIAS statement. Now, Campbell mentioned before during the external audit presentation before about the area of you mentioned the £2 million disclosure adjustment. We were just in the process of working that through now in terms of in relation to the external audit. We had treated the FAIRS data tool as an impaired asset, and on reflection and on technical discussion, actually the view that it should be treated as a disposal. In reality, there's very little effect. It will appear as a single line on the in the CIS statement as, you know, £2 million write-off of a disposal, as opposed to it being disclosed as an impairment. So it's moving it to a separate line, and that will be an adjustment that will be seen in the final accounts that get issued in September. The net effect of this is so there's the intangible assets in our intangible assets includes phase 2 assets, but it also includes the our systems that we use to operate the accounts, which is the ERP system. Now that was fully amortized this year. It was a 3-year amortization period, this being the 3rd year, or the year ending March 21 was the 3rd year. So again, what we've got now is we've got no intangible assets at all in the balance sheet, which makes the accounts somewhat cleaner and neater. And I think this probably reinforces Campbell's view about you know, the relative simplicity of our accounts. I mentioned before about REFCUS, which is revenue expenditure funded from capital under statute. These are effectively the P-vals that are installed by the TOCs in various stations. Again, during the year, we passed funding across to them. It would go through our CIAS statement as expenditure, and the TOCs would be able to capitalise those assets within their balance sheet. Again, I think we're on there's a relatively small tail on that now, still coming through, but clearly that will be finished in due course. In terms of pension accounting, this was quite an extensive item that was covered at the last meeting, but I think it's important to reiterate the same message that was conveyed by Ewan, because it is a figure that dominates our balance sheet. What we have effectively is there are 2 methods of valuing a pension. The first is what's called the International Accounting Standard 19, which is for comparability across accounts, both through all accounts produced by all entities. And the second approach is the actuarial valuation, and they utilise different valuation rates or discount rates. For the IAS 19 valuation, a discount rate used which is very closely aligned to the current corporate bond yield. And as members will know, is that when there's a bit of uncertainty in markets, investors tend to go towards safe havens. Safe havens are fixed rate bonds, so price goes up and yield goes down. And it's that reduction in yield that drives the discount factor for the IAS 19 valuation. So it's a very conservative valuation, but it's a comparable valuation that's used across all entities. The actuarial valuation is somewhat different. Again, that's a more in-depth valuation, but it's over a shorter window. But it assesses what level of contribution the business needs to make to meet its future liabilities. And it applies a slightly higher and less, I suppose, more favourable discount rate, and therefore it gives, one would argue, a more true evaluation that relates to the business needs in you know, what it identifies the contributions that are required for a 3-year window. The valuation is done every 3 years. It was done in last in 2019 for the 3 years effective from 2020, 21 and 22. It will be as a valuation due to be performed in March 22, which will have effect the following year. The valuation is done, then it becomes effective the year later. So, you know, work is expected to be done towards the back end of this year and early next year that will re-inform that the level of contributions that we make on a monthly basis for our members. I think the key point is that the two valuation methods can produce and do produce very different figures. And the IAS valuation, which is used for the statutory accounts, does produce a significant and large deficit from a valuation perspective. I think the key thing to note, though, is that this is a common issue within all local authorities, and I think we're faced with a 11 to 12 million pound pension deficit, but in some instances it's hundreds, if not billions, in other entities due to the different sizes of their schemes. So again, it's a common occurrence in all local authorities. I mentioned a prior adjustment. Again, this is I suppose it's a technicality. In last year's accounts, we had disclosed a movement in the reserves in basically in the incorrect line, and the way that this is addressed is that you adjust it in the current year's accounts, but state within the adjustment, within the note, that it's updated and adjusted. Again, we've been through this with Campbell at Mazars, and I think again very comfortable with it. I think, and again, it's just a case of making sure that readers understand when they see an adjusted note, they understand the reason why. Again, so it's moving a movement in reserve from one particular line when it shouldn't have been to the appropriate line that it should be now. And that same transaction, well, a similar transaction that occurred this year, or in this year's accounts, that was occurred in the previous year's accounts, and that's the reason why it came up, is that we looked at the movement this year and thought, well, hang on, it doesn't look right, and hence it's correct in this year's accounts, and we adjusted last year's accounts to be consistent with this year's accounts. In terms of moving on to the actual structure of the accounts themselves, I mean, I talk about the accounts being in thirds, which is, I suppose, consistent with the numbering. Is you've got the first third of the accounts is a narrative statement. The middle third is the main statutory accounts, and the back third is the annual government statement. I think the key thing from the first two elements of the accounts is that the narrative statement needs to be consistent with the statutory account. So again, it is reporting on matters that aren't necessarily of a statutory nature. It's reporting on performance within the year and looking forward into future years. It picks up on medium-term financial strategy, and it also picks up on movements in reserves, but aligns it to the account. In terms of the accounts themselves, there is obviously an independent audit report that's down at the back of the accounts, but there's a statement of responsibilities which is signed by the FD and the chair. And then we get into the core financial statements and the disclosure notes. Again, we'll go into some of those in detail in due course. And then you've got the annual governance statement at the back, which again maps out the governance framework that we have in place, and the various controls that we have in place. And I think again members saw the draft report last time around, which has remained unchanged, and we wouldn't expect it to change, but clearly if it did for any reason, we would highlight that to members. In terms of the actual statements themselves, there are three main statements, which is there's a comprehensive income and expenditure statement, a balance sheet, which contains reserves, and a cash flow statement. In terms of what we call it the CIAS, just the short for the comprehensive income and expenditure statement, it summarises all the income and expenditure of the year, and the key is from an accounting perspective, and that can be somewhat different. That is occasionally different, and it is different in this case to what we would do on a monthly basis. On a monthly basis, we budget an account on effectively on an expenditure basis, but at the year end we bring in statutory adjustments and accounting adjustments to represent the true set of accounts at the end of the year. And in fact, that's actually the second point there. There's a, statutory provisions and the application of accounting standards produces a set of statutory accounts from what was previously a set of management accounts. The key items that get considered are, how do we treat capital items? As was just mentioned before, that we had previously capitalised intangible assets, and during the year, events have given rise to the fact of that capitalisation to be revisited and the assets to be impaired. We've mentioned the pension liabilities. There's the recognition of grant income, which we'll come on to in a second, and again, recognition of provision of accumulated absences, and that really is a relatively small item, that one, but it's about aligning the entitlement of employees to employees' holiday entitlement to when it's been accrued, and in this instance, in this year, it went slightly up, again influenced by the fact that people are at home and remote working, and holiday entitlements have been somewhat impaired, or the ability to go on holiday has been impaired, not the entitlement. In terms of the actual CIS itself, again, this is an extract of what's in the accounts. Members will probably recognise the sort of basic structure, because it is presented in a way that's very similar to our management accounts, but that are prepared on a monthly basis. And so what you have is that people will recognise the main items, which is major roads, Northern Powerhouse Rail, IST, rail ops, and operational areas. That is a very recognisable from the monthly operating report, the financial section of the monthly operating report. In terms of the presentation, in terms of how it's structured, when I've utilised some of the boxes and I've numbered them, because actually I thought it'd be quite useful just so we all can focus on the ones at the same time. Above the line of that first subtotal, they're all ring-fenced grants. So we all recognise that MPR is funded from TDF grant, and again it is ring-fenced to that. There is nothing that is there's no ability for TDF grant to fund other activities other than NPR. Similarly with IST and Rail Ops through the Rail North grant. And again, the reason why operational areas are carried from an expenditure but not income is because the income isn't ring-fenced necessarily. It is available for us to utilise as is seen fit from a budget perspective. So again, in terms of the areas below the line, one of the lines is financing and investment income. All that consists of in there from an income perspective, there's 181,000. That is a return on the assets held within the pension fund. So again, that's a non-cash asset, but non-cash income, but it just comes out through it's reported through the actuarial report. So again, it's recognising the returns that we have on the assets that we have in the pension scheme. And the line below that is a combination of £7 million worth of core grant and £1 million of in-year capital grant funding, which we'll come on to in a second. And then at the bottom is that we do an adjustment within the CIS for it's an incremental adjustment, because there are items above there that relate to the pension fund. So this is the incremental adjustment that's required to finalise the accounting for the pension deficit. We've kind of moved the pack around a little bit, and we've put this slide here because we think it's quite, and again, I think it's quite an important slide, this one. What this effectively does, it links the management accounts to the statutory accounts. So again, from a management reporting perspective and from a monthly operating report perspective, members may well recall that we would have reported an outturn of 57.83 million. So that's the spend on all our activities, on an accruals basis. And then what we do is we process a whole series of accounting adjustments and statutory adjustments, for example, like amortization and pensions, and then a whole series of capital adjustments. And this was the impairment that I referred to before, which is 4.21. So these are all adjustments that are made to the management accounting position to derive the statutory accounting position. And the similar thing is done on the income side. So 57.83, which balances our expenditure in the management accounts, and a whole series of adjustments for pensions, which I mentioned before. That pension adjustment was the income from the return on the assets, and then a whole series of capital adjustments. And then a section below, which is how those, where we've got income that has been taken to reserves. This is where this is the adjustment in the reserve. So the amounts taken to and from reserves representing the amounts that are required to fund the activities in the year. So again, that's quite a good schedule, just because it ties up to it sort of brings the management accounts live into the statutory accounts. Okay, going on from a grant perspective, it's probably no surprise to members to realise that we are virtually entirely grant funded. There is a modest element and a very small element of recharge income in relation to TRU and Esk Valley, but it's relatively modest. The rest of it is all grant income based, which will either be incurred in the year and utilised in the year, or would flow through to reserves. The key issues around it is, how do we recognise the grants received as income? Where is it shown in the face of the CIS, and where, if the income is not applied in the year, where is the income held, whether it be reserves, revenue in advance, or if it is to be repaid, whether it be held in creditors. And the key determinants on how we apply that is whether the conditions have been met, whether the restrictions on use, which there are obviously in ring-fenced grants, and in certain instances, and we have one in this year's accounts, is where unused allocations may have been returned to the grantor. And again, I'll reference that when we look at the balance sheet in a moment. And the last item is key. The key point is whether items are of a capital or revenue in nature in terms of their grant. So again, I've lifted off just these are notes within the accounts, but I think it was just useful to focus on them in particular, just because I think it sort of brings it all to life for members. The point one up here is just talking about a general point, which is we do have ring-fence grants that are assigned to certain services and would only be applicable to those services. In terms of the second box, that's just recognising that it's recognising that there's a reduction between 1920 and 2021, which members will probably recall is hopefully will recall is the reduction in funding in year. We originally thought we were going to receive 10 million. We had received half of it, and then in the 4th of January, it was advised that would be reduced from £5 to £2 million to give us a £7 million core allocation, and that core allocation would reduce in future years. Actually not in future years, in the next year, to £6 million, and that whole matter will then be subject to the comprehensive spending review that will be submitted. We don't know the timing, but it's anticipated to be in early summer. In terms of the bottom section, this is just, again, it's highlighting the significant movements in certain grant funded entities. As members will be aware, last year there was an increase in NPR activity, and it's increased again, which is quite encouraging. And from a I suppose looking forward from the year past, it increases in the current year as well. It's probably no surprise to note that the IST ticketing revenue has reduced considerably, which is commensurate with the winding down and the termination of the programme. The third line is RefCus, which we've talked about before, which is passing grant to docs that enable them to capitalise the P-Vals, the actual P-Vals themselves, and the installation of them. And then the bottom three are all Rail North grants. They're all subject to indexation and ring-fenced as well. And an interesting little nuance this year was that there was an element of unutilised Rail North grant that was carried. So we've carried that into next year to be utilised as part of a ring-fenced reserve. Just in case members were interested, if on the face of the CIES, what you would see is income of 46.155. What you see on this schedule is 45,912. The difference being contracted income of £243,000, which relates to recharges for TRU and Esk Valley. Again, it just isn't grant income. It's effectively recharged income. So again, it wouldn't get disclosed within this this table, but it's a reconciling item between the it's the difference between what's in the CIS and what's in this note. Probably nothing else to add there, really. So just moving on. Just checking for time. We're doing okay for time, aren't we?
Yeah, fine.
Yeah. Again, what was mentioned in an earlier slide was the what do we do with grants that have been received and aren't utilised in the year, and the answer is a number of areas. I mean, you can have you have grants received in advance that have yet to be applied. There'll be capital grants unapplied. There's earmarked reserves, which would be primarily, and we've got earmarked reserves for Rail North grant that I just referred to before. We've got IST earmarked reserves. We've actually got a devolution reserve as well. And then you've got general funds, which is where our core grant would sit, and if not utilised, would accumulate over time. Again, this is an analysis of reserves, which I as an accountant, it's music to my ears, this schedule, because it's how do we what do we have to go forward and how are we going to utilise it. So again, the key areas to note here is just so. We've been through a budget cycle for 21-22, and some of the numbers here might resonate with members. So what we've got in here, we've got capital. So this is in the position in 1920, the end of March 20, we had £11.9 million of reserves. At the end of March 21, we've got £8.2 million of reserves. And the reserves have been retained in a number of instances for specific events. So the integrated smart ticketing grant here of 0.28 combined with the 1.25 of earmarked reserves down there, that gives us the 1.52 of funding that's required to meet the anticipated budget in 21-22 for IST close down. And we anticipated the vast majority of that will be, the lion's share of that will be incurred by July. But there would be a residual element carried forward. So we're carrying a reserve to meet the expenditure in the following year. That's the purpose of that. The second line, the integrated smart ticketing general grant line. Again, all that reserve was used for funding in year. So again, so the reserve is now, put it on a raise. Yeah. So the reserve has now been fully utilised. Again, members may recall, but in terms of the level of activity in the year to March 21 was through COVID was was less and remote working, so the level of draw on reserves was lower than anticipated. However, we still drew £290,000 worth of reserves, which gives us a closing reserve of £6.2 million or £6.17 million. In terms of the budget, members may recall that £2.5 million of that was agreed by the board to be utilised. So again, that drops the, if you combine, we would generally combine the core grant and the devolved powers earmarked reserves together. So that's a £6.67 million reserve. Of that, 2.54 was utilised in this year, and we anticipated it to be used £1 million in the following year and £1 million in the year after that, which therefore takes us down quite close to the £2 million reserve that we've agreed is a base level that's required for us to have a degree of financial stability. Yeah, that's just covering the point I mentioned before about the 1.52. Those two figures together is 1.52 reserve required for IST going forward. So again, it's a I wouldn't say it's a healthy, but it does give us some capacity to release reserves going forward if required. Again, linked into the level of activity that's going to be required by the business going forward. Okay, move on from that. Going into the balance sheet, and again, some of what we talk about now will link quite closely to some of the earlier slides. But essentially, in essence, it summarises our assets and liabilities. It shows the reserves that balance against them. And the reserves, it breaks into what's classed as usable and unusable reserves. Again, usable reserves are what we talked about on the previous slide, which is earmarked and or general funds. But then we have a whole series of unusable reserves which carry a whole, carry statutory accounting adjustments that are effectively non-cash, that wouldn't be available for the business. And actually, in this instance, a significant debit anyway. Okay, so here's on the left-hand side is the balance sheet in March 20, and the right-hand side is the balance sheet in March 21. So I mentioned before about the impairment of the intangible assets and the amortization of the ERP system. So that has effectively taken all our assets from 2020, and they are now written down to zero. So again, it creates a very simple set of accounts, which is good, but in essence, that's what we have. Is we are a relatively simple business. Level of debtors has reduced slightly. That's a combination of money due to us and or prepayments. All the money is due to us as at the 31st of March 2021. I think with the exception of £1,000 have been received, as you would expect. We've then got a cash balance of 80 million pounds at year end, which some could look at that and go, isn't that quite a sizable number? But I think you just got to realise why that's there. So we've mentioned that we've got reserves, so the cashback reserves. We've also got a business that is predicated. We accrual account, which means that we usually work in a month in arrears. So any activity that's incurred in a month, let's say the month of March, it wouldn't result in an outflow of cash until the following month. So with a business that has about 40 to 50 million pounds worth of activity, you would typically expect a 1/12 of that to be held from month to month. So you've got that. We've got reserves of £6.5 million from core perspective. We had £1.5 million from an IST perspective, and we've also got in one of the earlier slides I talked about grant income where it's received and it's not required. It might go back to the grantor. So we've also got £4 million of IST grant that's held in creditors that is likely to go back to the department. Now, whether we do a flip for the core funding in the year is just an accounting adjustment, but in essence, the reason why our balance is higher is because we're holding grants that ultimately will get repaid. Anything else of note on there? What I suppose the most interesting, I probably should have mentioned this first off. Actually, that line there should actually say net assets / liabilities, because the overall balance sheet has gone from a £9.2 million net asset balance sheet to a £4 million net liability balance sheet, which readers could say, well, isn't that a bit strange? But then if you think about it, if you take a step back, the movement between the 9 million and the 4 million is a consequence of two key items. One being the write-off of the intangible assets, which we explained before, and the second being the movement in the pension liability, which again we've talked before. So both those items would create would result in the net liability position being in place at March 21. And I think just taking it one step further is that if we are a grant funded entity, really all you would really have from if you receive grants in the year and you've got an accrual accounting methodology, you're going to have reserves equivalent to your accruals plus a reserve associated to your medium-term financial strategy. And then so you wouldn't expect necessarily to have significant assets in a business that is grant funded on a year-to-year basis. So I think what we're migrating to arguably is a more realistic balance sheet for TFM, which is a balance sheet dominated by a pension liability, which is driven by an accounting standard. That should say cash flow. It doesn't say balance sheet. This is referencing the cash flow now. So cash flows are usually they're very good because actually they summarise effectively what's happened within between two balance sheets. they summarise both cash and non-cash transactions, and then allow the balance to come back to this cash balance here, which is 18.021 million. So going on here, so what we've got is the cash flow statements typically start or do start with what comes out of the CIS statement. So there's a £8.2 million outflow, of which a large element of that was in relation to non-cash movements and statutory accounting adjustments. So that's adjusted for, and there's an adjustment in relation to the capital accounting for grants. So it's a relatively straightforward and simple cash flow statement, but what it shows us is that there's a net movement of £1.3 million in the year from a cash perspective, which takes us down from what was £19.3 million in March 20 to what is now £18.2 million in March 21. And again, the £18.2 million I've mentioned before made up of effectively 4 key items: grant repaid to the DFT of about 4 million, IST grant of 1.5 million, core reserves of 6.6 million, and then trade creditors of the balance, which is about £5 million. That makes up your 18 million. I mentioned at the last meeting that we needed to, or we had revisited the accounting policies. We presented the accounting policies in February of 21, and at that stage we hadn't undergone the preparation of the accounts for the year. We've been supported by EY in the account preparation for a number of years now, and I think it's probably safe to say that they probably did a bit more of an in-depth review of the accounting policies this year and brought them up to date with accounting standards. The key point that they noted was that none of the adjustments to the accounting policies would have affected or do affect the numbers that are in the accounts. So the numbers are still correct. So a lot of it's around just bringing it up to current levels of recommended guidance within the CITFA code. I think, Kevin, you previously mentioned the idea of having a track change document because you wanted to just focus on what had changed, and that's attached to the papers. It shows all the modifications from the version that we'd seen in February to this version now. And again, some of the areas do look extensive, but it's about bringing in current guidance from the CITFA code into our accounting policies to bring them up to date and to refresh them. Oh, here we go. Straight to the I hadn't realised I was so close. There's quite a lot in that, and I appreciate there may be a number of questions within information disclosed within that slide pack or actually the accounts themselves. So again, happy to take any questions at all from anything that's been talked about or not talked about in relation to the accounts.
Okay, well, that's very, very helpful slide pack, very, very informative. Thank you very much indeed for taking us through that. Can I throw it out then to members for any questions? And that obviously includes both the items in the slides, but if there's any detail in the actual accounts themselves that people want to query, then feel free at this point. Okay. Any?
Maybe need to take the slides down, Kevin. If we take the slides down, it'll that's better.
Okay. First question from Kevin. Kevin, I think you need. I think you're on mute.
Sorry, schoolboy error. Thanks for the comprehensive presentation, Paul. That was really helpful and really clear, I felt. So thanks for that. Just a question on reserves handling going forward. Oh, apologies, my dog's barking. I'll just come off for a second, shall I?
Is there anybody else that would?
Somebody at the door.
It's all happening at Kevin's house.
It was the mention of reserves, Kevin, that set him off.
Yeah.
I think we're all okay. It's somebody at the door. Sorry, apologies for that. It was just, the agreement that we had with DFT at the outset for the 2 million cash reserve, is that likely to come under some pressure and review as part of the comprehensive spending review and/or the reduction in core grant this year? So it's really just a question around the reserves. And then I had a sort of an observation on the KPIs on page 109.10, I think, in terms of the progress narrative. I just wondered whether we were doing ourselves a bit of a disservice in that several of the KPIs are linked, or failure to achieve, if you like, were linked to the DFT's failure to publish the IRP. So I just wondered whether we were doing ourselves a bit of a disservice by not sort of more explicitly referencing that. But that's probably just me being a bit whingy. I think that was it from me. Thanks.
Ian, do you want me to?
Yeah, I'll happily pick up the reserves one, Paul. Certainly, the MOU we probably does need a revisit at some point. It's been there since 2018. I think the intention would be to revisit that post CSR. I think we'll need to think quite carefully about it. And the TFN is we're in a slightly odd position that we're 100% grant funded, pretty much, but we are a standalone entity from a financial perspective. There's no open line of credit to the department, which says we've got a bit of a cash flow problem, therefore you give us money. So there is an extent to this that there are risks that we're exposed to, which may not be covered by grant. I mean, I think a number of those would represent control breakdowns within TFN, but that's not to say that those risks don't still exist. Hopefully, touch wood, the control systems that we've got and the processes we've got would minimise the risk of that. But they're still there. There is also risks associated with cash flow timing and timing of grants from the department. And we have had instances in the past where funding has been delayed from one pot of grant, and we've essentially cash flowed it from the reserves. Now, we are in an odd position as Transport for the North vis-a-vis other local authorities, is that we have no ability to borrow. The regulations, as you know this, Kevin, I've told you this many times, but that does introduce a level of technical insolvency risk into proceedings, our inability to meet invoices as they become, or liabilities as they become due, which doesn't exist elsewhere. So that 2 million needs to be considered in light of a number of competing pressures. So I think the other thing that's worth mentioning is that within the budget, the target is to get the reserves down by the end of this year to around 4 million. The budget was clear that the current level of expenditure is only sustainable with releases from the reserves. So £1 million ongoing support to operations. That would take you down to 2 million by the end of the next CSR period, if all other things being equal. But obviously, that's not. You can't have those run rates at that point. The critical thing in all of this is the CSR outcome, because as Paul says, we do have a reserve that we can manage, some level of financial shock. But in reality, that money can only be spent once, and the key thing is what is the ongoing funding over the next 3 years. The KPIs, might as well, whilst I'm here, might as well pick that one up as well. You're possibly right. I mean, that narrative was included in our monthly operating report for the end of last year. So I think that narrative is probably set now. We've extracted it for the accounts. I think it's quite possibly arguable why some of these things have been delayed, but I think we probably are where we are in terms of the narrative now with the KPIs for last year.
Okay, thanks, Ian. Cheers.
Okay, Thanks for the question and the answers. Any further questions to Paul or Ian? No, I can't see any further questions. That shows you've done a great job, Paul, and explained it very well. Just a comment from myself, there is a lot of information in the actual accounts themselves, and obviously in the notes of the accounts. So you tend to find points of detail in there if you need to refer further down the road. Just one area that does relate to the actual reserves, and page 108 in our pack, which is into the accounts, does actually talk about in the notes there the nature of the reserves. So picking up on page 10 or page 108, page 10 of the accounts, and the reserves are covered in narrative form there, and it does mention levels of certainty, etc., for going forward, and I think that's fair. So I think at the end of the day, we've got a comprehensive set of accounts which has been very well explained. So unless there's any further questions from anybody, I suggest we move on.
Chair, can I just raise one point? I mean, the accounts are very detailed. There's a lot in there. I did only extract certain key elements. So if members over the course of the next few weeks or months have any questions at all, then please feel free to email me. And if and again, we could capture that in the review in September if any questions arise. But I'm more than happy to detail with respond to any detailed questions that might come up.
Well, appreciate that offer. Thank you very much, Paul. That's very helpful. And of course, the public consultation ends, I think, is it on the 1st of August?
17th.
17th, is it? Yeah.
Yeah. Okay.
So there may be the odd question coming up from that, but as you mentioned before, we've not had many in the past. Okay. Thank you for that. Of course, just a reminder then, so the actual 16th of September will be the meeting where we take this forward for recommendation to the main board. Right. Okay. Let's move on then. So that takes us through to item 8, which is corporate risk review. And who's doing that with us today?
I was hoping Hattie would be able to join us, Chris, but she's been waylaid, so I'll pick that item up. I won't. This was corporate risk register report was discussed at the last Audit and Governance Committee meetings, which is relatively recent. So I wasn't going to go through in a huge amount of detail. I think it is just worth picking up. Paragraph 1.1 of the covering report just brings people's attention to where things have changed. I think the main things I'd just like to pick up are the first 2 bullet points. The first is that we've had a couple of instances of communications being passed on to newspapers. Obviously not particularly helpful, and particularly when it's things that are involved with the development of transport from the north positions. Obviously our circulation lists, certainly for matters where we want to consult members, include an awful lot of people, including members, LEP members, officers, people in national agencies and the like. And internal staff to TFN. So there's a significant number of people who are covered on our distribution lists. So that is seen as a potential, having the potential to be quite damaging to our relationship with the department, and it is something that's been communicated both to partner officers and internally. But I just wanted to draw people's attention to that in the risk register. I think the other thing is risk 6, which is around business operations, and the uncertainty of the outcome around not only the impending CSR, but also some key policy statements, not least of which is the integrated rail plan for the Northern Midlands. There was talk of that being published prior to recess, which is I think the 23rd of July. I'm still not clear as to whether that is likely to come out or not. I'm not sure who would give you that clarity, but I think it's worth just, you know, the increased risks around uncertainty have been picked up in the report. It's probably best if I stop talking, and if anybody's got any questions, I'm quite happy to pick those up.
Okay, open to the floor then. Any questions on the risk register? No, I don't think we've got any coming up, Ian. Just obviously, it's relatively easy to follow now in the new format. So I think the useful thing for me is the current risk impact line, which brings things to our attention, and obviously you've covered you know, the leaking of confidential information, etc., which is in there. But I think at the end of the day, we've got a good sight of the risk profile from this risk register. So I think committee members are well sighted on where the issues are and what's being done about them. So I think unless anybody's got any further questions on the risk register, we'll move on. Just pause there for a second. No further questions. Okay, that takes us to item 9, any other business. But before I just move on to there, if you just thank Hadi. I know she's not with us for a report there. Ian, thank you.
I'll do that, Chris.
Right, and as I mentioned already in the meeting, the next meeting is key really, because we need to have core membership to recommend the accounts through to the main board, and hopefully we intend to do that in person rather than by video link, and to a certain extent, depending on who is available to attend that meeting, may determine where that meeting takes place. So I wanted just to first of all ask if any of our membership would not be able to make the meeting on the 16th, if you could just let me know now or at a later point. Is there anybody who definitely can't make the 16th at this point? Okay, and I don't think we've got anybody coming forward there. I think
we need to check. I think we need, and Debbie, correct me if I'm wrong, but I think we need two elected members in order to be quora. So we've only got one at the moment. I think that we'd need to check with the elected members which of those might be able to attend the meeting. I think, Chris.
Okay.
Need to do that offline.
Right. Okay. Let's do that offline then. Thanks for that. Okay. Finally, any other business on any other matter that anybody wants to bring forward at this point? No. Okay. Well, thank you. We'll close the meeting then, and the next meeting is on the 16th of September. Thanks very much, everybody, for attending. Much appreciated. Cheerio. Thank you.
Bye-bye. Thank you.
Bye-bye.